sectors, and you're here to hear me talk all about consumer discretionary. Today is going to be our focus. We are going to start off, as we do each and every week, reviewing the broad markets where we sit currently, and then start diving into how we arrived to that situation, both on a very narrow basis, what's happening this month and this month alone, as well as looking back a little further in time to the start of the year and even beyond. I'm looking forward to talking a little bit about consumer discretionary. At the end of last week, I told you we might be talking about consumer staples. That seems to have fallen out of favor, so I'm glad we shifted gears. It looks like consumer discretionary will be the right one to discuss as we go throughout the presentation today. I hope you'll agree with me as we work through the presentation. I hate to give you any sort of a bait and switch feel when I tell you one sector is going to be coming up, but I like to keep it fluid, make sure we're talking about whatever is most topical and important at that moment in time. Today, our discussion, like I say, is going to focus in on the consumer discretionary area. And as we take a look across what's happening here in the markets today, I want to point out a couple of things. First, I want to point out that today we've got a very muted response in the S&P 500. We're currently down 8 basis points. That's actually better than it has been. It's recovered quite a bit since this morning. The Nasdaq's still off 25 basis points or so, 0.25%, and the Dow actually up by the same margin. But as we look into the sector performance, and those of you who are curious how you could get something like this, this is just one of the watch lists that this trading strategist has created for this test account. You're welcome to jot down these symbols and add them to your own watch list. That's how we have this heat map here and visible for us. But as you can see, what we are looking at is today a day of rotation is what we would call this, where we have some down pretty handily, but others up by about the same margin. The overall net impact resulting in the S&P 500 approximately flat. Let me grab a quick swig of water. Pardon me. As we take a look at that rotationary day, consumer discretionary is the spot that we are looking at today, our focus. Off about 1/3% today. We'll be looking at it in greater detail over the course of the coming minutes. But importantly, there's a few things that we like to hit as we go throughout this class each and every week. And thank you for those who have joined with me, not just today, but over the past several months as we worked through this class and ironed it into a pretty good process here. Number one, I want to talk a little bit about what the market has been doing overall. I want to talk then about some of the relative rotations and then dive specifically here into consumer discretionary. But our caveats to that, since this is a class that I run solo, I will not have access to the question and answer until close to the very end of the session. So if you have questions, please do send them in. I will do my best to answer them. Be as specific as you can because I won't know what time they came in except the order that the questions popped in. So go ahead and let me know what you're asking about and your question. All right, as we take a look here at the S&P 500, this is a chart just going back to the start of the year up till present, and clearly there has been a bottom left to top right end state here, but you all were with me over the course of the month of April when concerns were heightening. This downtrend line was in force, and we saw red candle after red candle lining up here as the market went down. I apologize, I still have some caught in my throat. I apologize, I've got something caught in the back of my throat. Hopefully that clears it up. All right, several red candles in a row, price going down, down, down. And then starting right here at the tail end of April, it was April 22nd, we get our first green candle, and that proved to be, in the end, a turning of the tides when we started marching upwards. And importantly, after going up, we came down and stopped going lower. This is the crucial moment for a trend. When we analyze anything on the markets, what we are looking for is the reversal points and connecting those reversal points. Our highs started getting higher. Our lows started getting higher. That is a change from what was occurring as we got lower lows and lower highs. Now we're getting higher highs, higher lows, and continuing forward. And the last few days has actually proved itself to be perhaps even more bullish than previously. We were going in this gentle, slow sloping recovery at the beginning. Then we start launching higher, and continuing the last 2 days, really just sustaining sideways slightly above where we closed out on May the 6th, back on here on Monday. However, this does, all three of these, put us above this upper end of what we might call a channel boundary for the trending stock market. As it has risen, it's now found its way into a new area. Sometimes that means that the most aggressive slope, the one that we arrived to this point on, all the green candles in a row, is what's going to continue. But more often, it means that now this line is the one to watch as our ongoing trend looking forward. We no longer need to rely on this one, which is so far down here at 50-50. Now we've got some answers right away in terms of a changing trend. So importantly, on the S&P 500, we've recovered pretty substantially. We broke out above our downtrend lines and even extensions beyond them. We've held on, even though today we started lower. Rallying back with strength is definitely to be lauded and something admirable for the S&P 500 to be doing. Knowing that that's the case, this is kind of our backdrop for what is happening for the markets as a whole. I also wanted to point out this change in the volatility scenario. Those of you who use options have likely noticed that the VIX has dropped back down. It had spiked up pretty handsomely, very quickly over the course of the last few weeks when the market was going down. But now that we've turned around and started moving back upwards, VIX is almost back down to where it was previously. And we're starting to see that show up in realized volatility as well. As we've moved sideways and started going up instead of down, 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 the size of our average move has started to come back down as well. Those are all signs of a bullish trajectory for the markets as a whole. Knowing that that's our situation, let's go ahead and jump in to the first of our sector-focused ideas, and that's always the relative rotation graphs. And today I prepared also this little key. I know that these index symbols on here aren't always the most intuitive. Today there was a nice gap on the chart where I could fill this in without covering anything important. So there we've got that available to you as well. But here's a few things to point out. The sector that we are focusing on today, IXY, consumer discretionary, it found its way into this leading quadrant. And as we look around in this quadrant, it looks rather lonely. In fact, staples, which dropped out of favor since we started mentioning it last week, utilities finding its way perhaps to stay in, but perhaps giving up on this as well. Utilities is up. But as we take a look, energy dropping substantially in relative strength. Coming up here, what are rising? We've got technology turning positive. We've got real estate holding on to a fairly positive week. Healthcare giving it up, going right back down. These are the materials and financial sectors right in here. So a lot going on as we take a look through these. But all told, what's our key considerations as we think through these? We want to recognize the relative strength against others. Right now, consumer discretionary is exhibiting strength in both momentum and price movement, positive for both of those relative to the rest of the sectors of the market. That's why it's going to be our focus for today in the consumer discretionary. This chart, folks, for those of you who are interested, comes from a third-party resource known as relativerotationgraphs.com. You're welcome to go out there and grab them for free. They're available as of the previous trading day. So this is through yesterday's trading activity when I pulled it off this morning. Next, we're going to take a look at the sector performance over the course of the last month. And here's where we're going to start for it. This is the final graph for what happened so far in April. So this is all of April trading. I like to do that when we're just at the start of a month like this. All of April ended up looking like this. Pretty scary. Everything down except utilities. Utilities found its way slightly positive. That's what put it in that right-hand side of the relative rotation graphs. It stayed there with some pretty good precision. But we'll notice that as we shift from here, real estate being the biggest loser, infotech second, healthcare third behind, the S&P losing a little more than 4%. If we go ahead and shift over and take a look at May's performance thus far, utilities has maintained its place in a positive performer instead of its consistent location as a contrarian against much of the rest of the market, especially over the last year or so. Utilities has often moved in the opposite direction than the rest of the market. Energy has done the same. You can see energy kept up that trend this month, utilities bucking it, adding 5% instead, led to second place only by communication services and information technology coming in at just less than 5%. All of that so far for the month of May has been enough to bring the S&P 500 3% positive. Remember, we lost 4% for the month of April, and we're already 3% back for the month of May. Important to see how quickly this recovery has really mounted and where it's come from. So we want to give due credit to information technology and communication services. And let's take a look now, along with utilities, to see where we are going besides this. Our main focus for today, consumer discretionary, at about 2.5% positive month to date, after the performance showing up in the month of April, fairly negative, over 4% negative. Let's jump over and instead view this on an annualized basis. Here's our annual version. First showing us what it looked like in 2023. You've all seen this many times, but the big focus here is that consumer discretionary, along with communication services and information technology, were the leaders amongst the sectors last year. This year, we're seeing communication services still showing up, information technology still showing up, but now being tied with energy and utilities for that year-to-date performance at just greater than 10%. Absent from the year-to-date performance has been consumer discretionary. Note that year-to-date, what we are looking at right here, consumer discretionary is up approximately 3%. And remember that for the month of May, the last week worth of trading, we also are up only 3%. So unfortunately, consumer discretionary has effectively been absent for the year, and now just starting up, showing up to the party a little bit late, maybe going to do its due finally. But nonetheless, consumer discretionary has thus far been a little bit of a laggard relative to its performance last year. Real estate, however, a true laggard, showing up as a negative 7% down for the year thus far. Clearly not a time to have been invested in real estate when you could have instead notched almost 20% positive in the communication services sector. So we'll take a look and see where this amounts to and how we have shifted throughout that time frame. But knowing that that's kind of where we're coming from, we know the sectors have performed thus. Now let's see it in a heat map style, focused in on the current performance over the last 4 weeks, as well as over the course of the last week. This is our 4-week performance broken down for the S&P 500 across all of the market. The brighter the color, the more extreme the positive or negative going on. You can see, for example, Meta over the course of the last 4 weeks off 10%, while Google up that same 10% or so, 9.4% for each of them. Clearly some big discrepancy going on there between two of the largest companies in the communication services sector. We see NVIDIA still positive, 6%. Apple, 7.5% positive. These are some of the things bringing the market positive over the course of the last couple of weeks. And that includes some of the selling that happened in April until our recovery began, like I said, about that 22nd of April or so. But our focus, consumer discretionary, let's zoom in on it and take a look for me. There are a few bright colors here. Notable ones on here are the Starbucks company down 16.8% over the last 4 weeks. We'll take a look at that chart, time permitting, at the end of the class. Certainly a concern for the Seattle-based coffee company. Starbucks off 16% over the last 4 weeks. Chipotle, however, adding 9%. It's not all restaurants that are suffering, but rather something affecting Starbucks and other companies. But nonetheless, Chipotle bucking that trend, moving strongly positive instead. Notable other positives in this hotels, leisure, and restaurants industry: Domino's Pizza and Royal Caribbean. So there is a bit of variety showing up in there in what could eke a positive result. You'll notice that Carnival Cruise Lines, unfortunately, down 9%. So definitely some deviations between similar companies, but nonetheless, opportunities for large moves, positive or negative. Garmin also up 14%, not an area we talk about too often, but we've studied now each and every sector of the market, and we just talked about the fact that real estate has not been the place to invest over the course of the last year. But I'd like to remind you that real estate is not real estate that you might picture. For example, there's several neighborhoods going up near me, several real estate developments by large producers, the likes of D.R. Horton and also Lennar. Household durables is where we find home manufacturers, home builders show up here in this household durables. Perhaps not what you would have expected, but they do find themselves in the same sector together with automobile components, with a number of different automobile manufacturers, as well as some of the specialty retailers like we see here. Household durables, seeing that performance positive for the home builders over the course of the last 4 weeks, off 4.5%, 3%, Garmin up 14%. So that's what we're looking at across the various sectors for the last 4 weeks. Let's dive into that same consumer discretionary sector, but now looking at just the last week. And you can see there is one big shining star in that time frame, and that is Amazon, up 8% over the course of the last week. We can see Starbucks off still that 18%. Its large move came shortly after earnings, and that's still in the last week's worth of trading. Expedia off 16%. Household durables as an industry up 7.5% on the backs of good performance from those home builders, 17% positive for Garmin, and even DEC down here up 5%. So a lot going on here in the consumer discretionary sector, but it's worth pointing out how different some of these companies are. We're talking about comparing Airbnb to McDonald's to Las Vegas Sands to Expedia.com, all in that same area, and including in that comparison your Teslas, your Nikes, and even your AutoZones. So there is broad variety within consumer discretionary, but the whole idea that pins these together is theoretically these are things that will do extra well when the market, the economy, is doing extra well. But they will tend to underperform when the market tends to pull back. Economic crunches are going to hit these companies perhaps harder than others as people stop buying their lattes, as they stop going to the casinos, as they stop even buying expensive replacement parts at AutoZone. So all of that is theoretically tying together the consumer discretionary area. Maybe this is a spot where we would like to draw more fine lines ourselves if we were doing the breakdown. But this is what we get from the GICS Global Industry Classification System. All right, with that sector heat map pulled up, let's go ahead and hit our final graphic. Static information on seasonality. For consumer discretionary, we've had a notably positive trend ever since 2013, the last decade worth of information for XLY, which we'll use as the proxy for the sector has been decisively positive, except the start of 2022. And even then, thereafter, it recovered relatively quickly and has at least flattened out, if not moved back to positive. As we glance over the time frames in the year that have been positive or negative, remember we're glancing at this zero line and we're looking for the areas that are consistently beyond that zero line in one direction or another. Most all of our activity is between 2 and -2 on this. Those are dollar terms for the fund, which trades at about $120 per share. So $2 plus or minus isn't the largest seasonal impact. But if we were to point at one, it would be that this season is a little bit negative, as is October for consumer discretionary as it sits currently. With the seasonality behind us, we're ready to jump into some charts and find out what's really been happening in this sector and where we may be looking going forward. XLY as an ETF trades at right now $177 per share and has been trending upwards about since that same time frame late last month, just like the S&P 500 turnaround at April 22nd. It rallied pretty strongly, but its chart does look different to me as I glance over it. Notably, we still have some possible downtrend lines to contend with as we draw them in and watch what the market's doing. We also see that today's pullback of 0.5% is notable and puts us at a decision point for the sector today. It seems to have bounced, holding at an important spot right on our upwards trajectory, our upwards trend line, and that's good news, exactly what you'd like to see. But nonetheless, it does put us balanced right on the fence at the mercy of the wind pushing us the wrong direction tomorrow and seeing us instead careening back downwards as a sector if tomorrow does not hold up positively. If we swing over and take a look at this with some of the moving averages, you can see that the swing down was fast enough and prolonged enough to turn our 20-day moving average down, the red line, our 50-day moving average down, and both of those still remain in their negative tilt thus far. It also was enough to flatten out, but not turn negative, our 200-day moving average, which is approximately where we found our footing and returned back higher. Notable, therefore, that we are currently below the 50, although above the 20 and 200. You'd like to see some evidence of that price pulling those moving averages in the right direction, making a convincing argument that under short, intermediate, and long term, we have a positive trend back on our hands. Thus far, hard to say that this is a clear-cut, ironclad example of that type of movement. Next, I wanted to take a look at some of those largest performers over the course of the last few weeks and show some of the disparity that showed up over the course of that time frame. One of the biggest drops was this one, 14% overnight for Starbucks, just from this starting point, its earnings report, and right on down here to the first thing in the morning price, over 14% negative on the earnings report. As we take a look, it was coming into that earnings report already on some gentle but nonetheless negative slope. It had tried to rebound a little bit going right into the earnings announcement, but unfortunately, momentum was not nearly enough to override the negativity viewed in the report at 68 cents per share, price dropping all the way down here into the mid 70s after living in the 90s. If I go ahead and back my chart out over the last 2 years, you can see that brings us back to the same prices we were fretting about in 2022. Do you remember what 2022 was? That was a year when we went down consistently all year long. Starbucks had it worse than many others, having a drawdown of not some 15 or 20%, but rather losing peak to trough nearly 50%, folks. That was a substantial move. Right now, we had seen a lot of that recovered, moving up by some 60%, but bringing us back down to where we are now, losing yet again 30%. So over the course of the last 5 years, there has been opportunities through till today to make as much as 40% if you happen to be lucky enough to buy right here at the lows in COVID, or to lose as much as 40% if you bought even recently at our more recent peaks. Nonetheless, the current trajectory for Starbucks is reminiscent of one that we saw several years ago for Meta. After a substantial drop in its price post-earnings, it unfortunately was unable to find its footing. I'll zoom in so we can see it a little closer. It had a very similar look, gentle downward slope, tries to rally into the earnings, then sells off substantially. In this case, actually even more than did Starbucks. But this was the problem. It kept on going. Even though it had already lost 30%, then it kept going and lost another 25% after that move. Starbucks, thus far, what's happening in its most recent activity? Tries to rally, earnings knocks it down, and thus far, down has been the direction it's continued. Is there a possibility it keeps going down further? Absolutely. Will it? Only time will tell. But be aware that yes, the price most certainly can go further down. If you are wondering, thinking there's no way it goes lower, just be aware that even a very large successful company can continue much, much lower. Worse still, if they prove to stop being a successful company over the long term. That's our quick look at Starbucks. Next one, if we go ahead and swing, actually, I did want to show you where that looked compared to the moving averages. This was far enough down and long enough down that we are well below the 200-day moving average, pulling on the 50 and the 20 in a dramatic negative direction as well, given the most recent price information. With that, let's go ahead and jump over and look at Ford, a very different company than our Starbucks. And its chart does look very different. In this case, I've got mostly horizontal lines drawn in. In this case, pointing out the peaks from February proved to be the peaks in March, proved to be the peaks in late March, and then we tried higher, but rejected, and came back and at the earnings event late last month, unfortunately found that this was not good enough to finally set our sights above $13 per share for Ford. That brought the price right back down to its current values here at about $12 per share, right along with the lows from February, the lows from March, the lows from April. Hopefully, they will prove to be the lows for May as well, rather than a new consistent downtrend driving the price for Ford stock right on down into the dumps. As we take a look at its moving averages, it too has a downward sloping 200-day moving average. But curiously, the price has been above that downward sloping 200-day moving average for a large portion of the last couple months. However, not by a large enough magnitude to outweigh these large values back here that were part of the calculation a year ago and are starting to drop off. That's why this is continuing to move lower in spite of the price being currently above the moving average. Instead, the true math behind a simple moving average is every day we replace one of these old values with one of these new values. Whichever one is higher or lower will result in a directional change for that moving average. Right now, we are replacing current level 12 with what was once 14 and 15, driving, therefore, this pricing downwards over the course of that 200-day moving average. The 50, however, is benefiting from instead a slight positive, again, even though we've spent a good portion of time on the wrong side of it. Similar things at work there, but instead we're dropping off some of this baggage, lower prices, replacing it with slightly higher. That's where we're looking on Ford Motor and its current trajectories. If we look at it on this trajectory, I would certainly be aware of the price dropping to or below $12 per share. and instead aiming for it to be looking at $13 per share, as this channel has thus far proved pretty stable over the course of the last 3 months. It looks like we have time to hit that one last chart that I had prepared for us. This is the Chipotle Mexican Grill. Its chart is absolutely different. And in fact, I got into the habit of drawing this in red, but this should be a nice green upwards trajectory. Trend was going positive, positive, positive. It struggled just a little bit right into its earnings, but earnings said, here we go higher yet again. We're trading now in excess of $3,000 per share. Time for Chipotle to shrink that share size by doing a share split, if you ask me. But over $3,000 per share is what we're looking at for Chipotle. And if we look at its 5-year chart, it has been on an absolute tear, well above previous peaks. We go back 10 years, we see this company has never been in a realm like it is right now. If you happen to been an investor over the last 7 years, you've 10x'd your money in Chipotle, going from $300 to over $3,000 per share. That short term is relatively positive as well. We see positive 200, positive 50, positive 20, and price above all of them, pushing ever higher as it's moved its profits in a successful way for this corporation. Very impressive results from Chipotle, and continuing that way even over the course of just this last year. You've had an opportunity to double your money, or nearly so. Folks, that brings us to time, and officially we'll close not presenting any additional new material, but thank you for being here with me. From here until we close out the session, I will only be responding to your questions. So thank you so much for joining with me. I hope this was worth your while. You got a lot out of it. It was a quick look at consumer discretionary over the course of this time frame. All right, let's take a look here. Russell says I'm showing off by looking at those heat maps, zooming in, zooming out. They are a fun thing. I'm very proud of putting that together. It's something that I built myself using some of my own programming expertise. And we did have somebody asking where I get these. I make them myself using data downloaded from Fidelity Stock Screener, but then I compile it into this heat map. If you would like to have one of these and not do all the work yourself, I cannot provide this to you, but there are similar ones out there freely available. For example, finviz.com has a heat map that's very similar in nature and behavior. You can also look at information over the price performance in recent activity, its PE ratios, and many other customizable settings. So that's at least a possible third-party resource you might consider if you were interested in doing that. Neil, no, it is not available on fidelity.com. Let's see, what other questions? Jim, I don't have the next Excel spreadsheet session on the calendar yet, but I will let you know when that date is. By next week, I think I should have a pretty decent idea when that will happen. But thank you for asking. Let's see. Question was, should we buy Starbucks now or not? Here's the Starbucks chart. What we know is right now it's dramatically cheaper than it was before. But the reality is it's cheaper now, not because you're getting the same thing as before, but because we know new information and the market says that it makes the company worth less than it was before. As a technical analyst, we assume that the current price is the fair price, the right price, and then we observe the current direction of trend. Right now, in the very, very short term, the trend has been negative, and it's coming off of a dramatic drop down lower. Even though some would say, well, it has to fill the gap, be aware that it only has to fill the gap if it goes up. It may never fill this gap if it only goes down from here. There is certainly that possibility, and be prepared for that if that's the case. Should you be a buyer here? Only if you're under the impression that it's going to rebound. Currently, the immediate reaction and follow-on reactions in the price have indicated a negative trend for the security. If you're going to be a buyer here, do so recognize you are swimming upstream. Great question. Follow-on question as well. Should we then sell Meta for some of the same reasons asked at the same time? Not necessarily. It sold off immediately after its earnings in the most recent one, but then went up, 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 up. Do you see how different that immediate reaction is than what we've seen so far in Starbucks? That's the right direction, what you'd like to see occur. Whether it will continue that direction or not is still to be seen, but it's moving in the most short term in the right direction, positive, positive, positive as it moves up and down. The death cross or golden cross, DD, is referring to when our moving averages cross over one another. It's when the 50, this blue line, crosses with the 200. We saw one of those not too long ago for the S&P 500. If I go ahead and back this out and take a look on here, we had several of them occur in the last couple years. And this would be our golden cross when the 50 comes from below to above the 200. The death cross is when it goes in the opposite direction. Let's see. Russell says that Chipotle had announced a 50-for-1 stock split. I thought I remembered something like that, but I didn't want to say it without validating. Russell, thank you for filling in the crowd. 51 stock split would bring it down to a much more approachable $60 per share or so. So far better than 3,000. Emmy, I would like when doing a specific sectors, also focus on ETFs that focus on that sector. I hope you saw that XLY is the ETF that we did focus on that does focus on that sector, but it's not the only one. And you certainly could look at others as you work through them. This is the Select Spider Fund. There's one for every sector in the S&P 500, and that's why we've used those regularly. But there are others out there as well. Thanks for bringing that point to light. Okay. LK wondering what that CMG chart might look like after the split. Theoretically, a stock split means nothing for the company. It's just changing out your $5 bills for $1 bills, or your 20s for 5s, or your 5s for 20s. It's the same number of dollars, the same value. However, a stock split to bring the price down is usually viewed as positive, not because of the split, but because there was a need for the split because the stock went up so high. And likewise, a reverse split is looked at negatively, not because of the split, but because instead of the fact that it's necessarily based on the price going down, down, down so much. All right, let's see. It looks like that may cover most of this. The Fidelity Stock Screener is here at oh, perfect timing. You come to News and Research, then you click on Stocks right here. That's the page I'm looking at. And then from that Stocks page, you can click Screener Tools. And then here under Stock Screen, I've created my own custom screen to make this easy for me to export the data. Here's the criteria. You are welcome to jot these down and do the same if you would like to see similar material. What I'm doing is grabbing all the companies in the S&P 500, showing their sectors, adding their dividend yields, price to earnings ratio, price performance, total return, price to earnings, etc., right on down the list. A lot of information on here that you can download and export. That's what ends up feeding its way into this report that I made, and this also drives that overall heat map as it works through. We didn't spend a lot of time looking at this one due to time constraints today. Tom, you say you like the FinMiz one, but not quite as much. Well, I'm glad you enjoy mine as well, Tom. Hopefully the commentary helps as well, but appreciate the sentiment. Thanks very much. Let's see. Okay. I think that's going to have to come to a stop there. There are several questions still in here, but we've got to close out so the next class can get prepared. Thank you so much. Many of these were feedback to me, ideas on how we can do better and things you've enjoyed. So thank you very much for the feedback. I do greatly appreciate it. I'll read through these in greater detail hereafter, but thank you very much. I wish you all the best. This was Jake Talk Sectors, and today we talked all about consumer discretionary. Huge variety in this sector, more than in many others. Industrials perhaps beats it in the amount of variety showing up. But if we were talking about comparing Amazon to AutoZone, we can see there's a broad variety going on here. Throw in the fact that we also have Home Depot, Lowe's, and many other specialty retailers. You can see this is a broad sector of the market. Thank you for being here with us. I appreciate you spending your time with me, and I hope I've entrusted enough information to you that you will come back 1 week from today where we revisit these same ideas next on our upcoming sector. It may be that we swing around and think about the consumer staples, but it seems to be falling out of favor. So I'll let you know in our other sessions along the way what we're looking at over the course of that time. Until then, thank you so much. I appreciate your time. I wish you all the best. Take care.